Welcome to the Skilled MBA Case Study Series. Ruchi Soya Industries Limited's transformation under the Insolvency and Bankruptcy Code 2016 highlights the impact of strategic ownership changes and capital infusion.
Ruchi Soya Industries Limited's transformation under the Insolvency and Bankruptcy Code 2016 highlights the impact of strategic ownership changes and capital infusion. The company's revival illustrates effective insolvency resolution, addressing external shocks and internal failures. This case study provides insights into navigating financial distress and achieving business turnaround in India's dynamic market environment. Ruchi Soya Industries Limited, once a dominant force in India's edible oil and fast-moving consumer goods sector, faced insolvency due to external shocks and internal missteps. This case study explores Ruchi Soya Industries Limited's journey through the Insolvency and Bankruptcy Code 2016, highlighting the complexities of corporate insolvency resolution and the path to revival. Ruchi Soya's decline into insolvency by 2017 to 2018 highlights critical lessons in corporate resolution under Insolvency and Bankruptcy Code 2016. Key factors included market volatility, financial mismanagement, and strategic missteps. The Insolvency and Bankruptcy Code framework facilitated structured resolution, balancing legal and operational mechanics. The process incurred explicit costs like legal fees and implicit costs affecting reputation and trust, impacting Ruchi Soya Industries Limited's competitive position post-resolution. Ruchi Soya's insolvency was triggered by an import duty hike, adverse monsoon cycles, and speculative hedging. Failed restructurings and creditor pressure led to Insolvency and Bankruptcy Code intervention, forming a committee of creditors. Patanjali's acquisition infused capital, despite market skepticism. The outcome was operational restructuring and balance sheet repair, steering the company towards renewed stability. The Insolvency and Bankruptcy Code, IBC of 2016, revolutionized creditor-driven resolutions, emphasizing a time-bound process. The Committee of Creditors, COC, evaluates plans within a 180 to 330-day framework. Transparent bidding maximizes recoveries, while the distribution waterfall prioritizes operational and financial creditors, influencing recovery expectations and creditor behavior. High leverage ratios indicated financial stress, with debt-to-equity imbalances and deteriorating interest coverage. A working capital crunch emerged from tightened supplier credit and inventory issues. Profitability volatility was driven by margin compression due to duty changes and commodity fluctuations. Liquidity mismatches arose as short-term liabilities exceeded operating cash flows, resulting in defaults. RSIL's position in the commoditized edible oil and fast-moving consumer goods market highlights the importance of scale, distribution, and brand equity. Competitors with diversified portfolios and robust balance sheets manage market shocks more effectively. Analyzing competitors' financials, including profitability, leverage, and return on capital employed, underscores RSIL's vulnerabilities before entering the Insolvency and Bankruptcy Code process. Financial distress incurs explicit costs like legal fees, insolvency professional fees, and restructuring advisor costs. Implicit costs include reputational damage, customer and supplier churn, employee attrition, and increased capital costs post-restructuring. Manager distraction further exacerbates these challenges, impacting overall business stability and recovery potential.
Pre-insolvency and bankruptcy code restructuring offers speed and brand preservation, but risks unfairness and backlash without creditor consensus. Formal insolvency and bankruptcy code resolution provides transparency and potential for higher recoveries, though it faces time constraints and operational risks. Liquidation ensures asset sale, but results in lower recoveries, job losses, and reputational damage. For RSIL, an insolvency and bankruptcy code-enabled going concern resolution with a strategic investor is recommended. This approach ensures fresh equity and working capital, an operational turnaround plan, and governance changes. The rationale is to leverage RSIL's business potential, preserving value and jobs through a structured process, yielding superior recoveries. Phase 1 focuses on stabilizing RSIL by securing liquidity for critical operations and appointing an interim Chief Financial Officer/Chief Operating Officer. Phase 2 involves engaging an insolvency professional to manage the Insolvency and Bankruptcy Code process, preparing a business plan, and soliciting bids. Phase 3 targets post-resolution turnaround with capital restructuring, operational improvements, and brand rebuilding to restore market confidence. A new governance structure is established with a board featuring independent directors and financial covenants. A robust monitoring framework ensures regular reporting to key creditors and independent monitors, maintaining oversight until stability is achieved. Creditor recoveries have improved, with secured creditors benefiting from higher going concern valuations despite potential haircuts. RSIL's operational revival is underway, aiming for positive cash flow and market share restoration. Employment is preserved, albeit with some rationalization. Market signals show discounted prices, reflecting risk-return trade-offs, while investor sentiment shifts from skepticism to optimism as financial stability and governance norms solidify. The Insolvency and Bankruptcy Code's creditor-driven model aims to balance recovery maximization with preserving Reliance Strategic Investments Limited's going concern value. Promoters' roles in restructuring are debated, especially regarding bidding rights and necessary safeguards. Macro policy changes, like tariffs, can exacerbate firm vulnerabilities, impacting economic risk distribution. Quantifying implicit costs, such as brand erosion, is crucial, and preemptive mitigation strategies are essential. Further protections for operational creditors like farmers are under consideration. The Insolvency and Bankruptcy Code, IBC, of 2016 empowers creditors, offering a legal framework for swift business reorganization, crucial for valuation and strategic decisions. Bankruptcy arises from external shocks and internal missteps, highlighting the need for robust risk management. Preserving going concern value benefits all stakeholders, while effective turnarounds demand both capital and skilled management. For inquiries, reach us at our Modinagar office in the National Capital Region, Uttar Pradesh, India, postal code 201204. Contact us via mobile at +91 875 5300 795 or email at support@skilledmba.com for support and further information.